Funding for Market Journal is provided by the Nebraska Soybean Board.
No matter how you look at it, animal agriculture helps Nebraska's economy. The livestock industry provides increased tax revenues for schools and community services. Livestock enterprises also create jobs while contributing to existing businesses such as local banks and grocery stores. A thriving livestock industry helps maintain our current way of life, but also provides opportunities for the next generation of farm families. The Nebraska Soybean Checkoff helps to raise awareness of the importance of animal agriculture to Nebraska.
Market Journal, television for agricultural business decisions, is a presentation of the University of Nebraska-Lincoln's Institute of Agriculture and Natural Resources. Promotional support is provided by the Nebraska Farmer Magazine, and major funding for Market Journal is provided by the Nebraska Soybean Board. The Soybean Checkoff, growing opportunity from the ground up.
Welcome to this week's edition of Market Journal. I'm Jeff Wilkerson. On this episode, Jeff Peterson analyzes corn and soybean markets. Dick Perrin explains the drop in crude oil prices. Roger Wilson estimates the cost of producing corn and soybeans in 2015. And Kate Brooks talks about export markets for U.S. beef. Jeff Peterson from Heartland Farm Partners is our marketing analyst this week. The USDA will release its latest estimates on supply and demand Wednesday. The agency is currently surveying tens of thousands of U.S. growers for its final report in January on harvested acreage, production, and storage. Jeff joined us Friday morning to talk about his expectations for this year's crop, how oil is affecting corn and soybean markets, and to look ahead at prices in 2015. Are you getting a final sense of what this year's crop looks like?
Yeah, no, that's always a fun time of the year, Jeff, is that, everything's coming together. We aren't expecting, as we look at this next crop report, we really aren't expecting any type of changes on acres or yield. I think the whole focus will actually be on the demand side. And as we study that, the only thing that we can see, Jeff, that we think needs to be adjusted, we think the soybean exports should maybe come up 15 to 20 million bushels. So as a result, the ending stocks, as we look at corn, remain unchanged, I think, going forward. On the bean side, though, I think we should tighten up that carry out about 25. So we could be looking at the ending stock number about 425 million bushels.
We'll look into 2015 and what you guys think will happen with acres once that planting season rolls around.
Yeah, I know. That's that time of year again, isn't it? What we're looking at right now at our numbers show is probably a minimum of about 3 million acres of extra beans. Now, if the weather's really good, that number, and everybody can get in the field and plant like they should, that number could go as high as 5 million more acres of beans. Over on the corn side, though, as a result, we'd expect about 2 million acres less than what we had last year.
So 3 to 5 in beans, meaning what? What does that mean for the outcome?
Boy, you're asking all the right questions today, Jeff. What that means in the outcome is as we put those into our balance of supply and demand tables and look at the ending stocks, which is always the important number to look at, this year we're somewhere around about 450 million bushels carry out. That would take us up to 750 million bushels. Now, if we translate that into price, all of the things being equal, and we don't see much for weather problems coming out of South America, nothing really changing anywhere else in the world, and those are big things to assume. We'd be looking at soybeans in probably the upper sevens.
All right, we'll come back to recommendations later on, but short-term movement for beans, where's it coming from?
Yeah, short-term, and that's what's been the big thing. Early on, it was all about soybean meal. That was driving prices higher. Now, since it's rolled over, it's hard to believe, Jeff, since our November high in soybeans, beans actually probably dropped a little bit over $1 a bushel. And that type of move, that's really been pure technical. As the traders ended up getting more comfortable with the amount of supply of meal, and they're getting more comfortable with that. We're seeing the basis levels drop in the Eastern Corn Belt. As the rail value started to soften, and that is happening. Each week the reports that come out show weaker rail values. As that started to happen, we see individuals start selling soybeans, and then technically we ended up breaking some up, key uptrending support lines. And when that happened, we started seeing the market move lower.
Crude oil impact?
Yeah, crude oil definitely is a big part. I mean, if you look back to it, crude oil, haven't seen prices this low really going all the way back to September of 2009, back 2009. it's down, over 40%. That's a huge number. So it definitely puts some pressure on beans, and for that matter, corn also.
Yeah, into corn, how does it affect ethanol? And for that matter, what is your opinion on ethanol right now?
Yeah, it definitely is an impact on ethanol. We got to respect what's going on in the crude oil market because it's a key component of the pricing of corn. As we take a look at ethanol currently year to date, and this is based off of really the last numbers that came out of EIA on Wednesday, their numbers would show that USDA says, we're about 4.6% ahead of last year. Currently, USDA is forecasting really the demand really for ethanol, the bushels going in ethanol, to be pretty much unchanged. So it's running a little bit ahead of pace. We think as it goes through the rest of 2014 and into 2015, we think the demand for ethanol is going to stay pretty solid.
Tell me where you think corn and beans right now are valued. Are they overvalued, undervalued?
Yeah, that's the right question to ask. And right now, we would say for both corn and beans on the 2014 and 2015 crops, from a fair market value perspective, they're overvalued. There's no doubt about it.
How does that affect your feelings on selling both new and old crop in both?
Yeah, so as we've seen this move go higher and as it started to roll over, we want to be a seller. And I know I've been saying that for quite some time, but we do feel that there's downside risk in the 2014 and 2015 crop years. So we'd want to be a seller on corn, also on soybeans, probably more so on the beans than even the corn.
Next week, Nick Miller from Stuart Peterson will give us his thoughts on corn and soybean markets after the USDA releases its December crop report. We mentioned in this week's marketing analysis the impact oil prices had on commodity markets like soybeans. Dick Perrin is a professor in UNL's Agricultural Economics Department. He wrote in September the U.S. would soon face a glut of crude oil. With prices already tumbling, OPEC, the 12-member organization of the petroleum exporting countries, decided last week not to alter its production levels. This country, after dramatically scaling up production, recently increased its oil reserves to 36 billion barrels for the first time since 1975. Gasoline prices, meanwhile, are under $2.80 per gallon for the first time since October 2010. We talked with Dick Thursday about the implications of cheaper gas to the U.S. ethanol industry, how OPEC's decision could impact U.S. production, and how steep the drop has been in crude oil prices over the last half of 2014.
Yes, it's been pretty dramatic. It's gone down about a little more than 1/3. Back in as late as 1st of August, we had prices of U.S. petroleum selling for $105. West Texas Intermediate was selling for $105, and today it's selling for $67. So that's almost a 40% drop in 4 months.
So what has contributed to this drop?
There's been a lot of pressure building up over the last few years on the market, kind of a bear pressure, because we've had steady increases in production from a number of world suppliers. Russia has gone up 1 or 2% a year over the last 6 or 8 years. Saudi Arabia, those were the two biggest producers other than us, they went up a couple of percent per year over the last 5 years. And the U.S. has almost doubled our production since 2008. So we've had this buildup of additional supplies tending to push markets down, but there's been a lot of uncertainty. The prices have not fallen very much over that period because of uncertainties related to Middle East tensions and other similar issues. So the result has been it's kind of like an earthquake. We've had these pressure building up, but it didn't break until last week when OPEC met to decide what to do about these burgeoning supplies and slipping prices. And suddenly they decided they were not going to do anything, whereas normally they would have cut back their own production in order to keep prices from falling quite so far. They decided not to do that. They said, let the prices go, and we'll shake out some of these new fresh faces in the market and get them back out of the market, and then we'll be in a long-run solid basis for prices again.
Was one of those fresh faces the United States of America?
Absolutely. Most of the experts think that the back-end fields in North Dakota and the Simeon fields in Texas can continue to, once they've got these drilled, they're going to continue to flow, because the big cost is the capital cost of finding the wells and getting them opened and running. That's been done. The oil's flowing. The cost at this point then of keeping them going is not so very high, and so they're expected, I think most people expect our level of production to continue even with prices as low as $55 or $60. Maybe when we get to that point, there might be some reduction.
Some analysts expect gas prices in the U.S. to drop below $2 a gallon. Locally, Nebraska is the second biggest ethanol producer in the country. What effect do lower gas prices have on ethanol production?
Ethanol is a substitute for gasoline, of course, and it won't substitute at a price unless it's lower than gasoline price, because the energy level of a gallon of ethanol is about 70%, about 2/3 actually, of the energy in a gallon of gasoline. So if you priced ethanol on the basis of the energy that it contains, which should translate into mileage, the work that it does, it ought to be about 70% of the price of gasoline. It's been priced higher than that in the past because of mandates and some other issues, but in the last year or two, it's been priced close to the 70% level, even sometimes a little bit lower than 70% of the price of gasoline.
So tell me where we go here, short term, and then in a couple of years, maybe what you think could happen for oil prices.
In the short term, we're going to have gasoline prices around the $2 level, I would guess, through the next year. I could be wrong, but I think that's a very reasonable expectation, and that's going to put a lot of pressure on the ethanol plants. The operating margins will be small. As long as the corn price stays close to $3, right now it's around $3.50, and that makes it a little difficult for the ethanol companies to take $3.50 corn and sell the ethanol for $1.40. They can just about break even on their operating costs. Most plants can, at least. Plants that have high capital payment schedules may have to shut down again, may go out of business again. It'll be pressure, but I think most of the plants will be able to continue operating at the levels they are now. It just won't have a very large margin to pay off their capital debts and so on. So that's the short run story over, say, the next 6 months or so. Longer run, I think the primary expectation is that over the longer run, the economies of the world begin to pick up. Some of these new suppliers, petroleum suppliers, may cut back a little bit on the amount that they're pumping. And the result of those two things, there will be a gradual increase of prices until we get, I imagine 3 or 4 years from now, it would be reasonable to think that we're going to be back around $80 or $90 a barrel for petroleum. That's what I would expect. But the unusual thing is the tensions, the potential for disruptions in supply. Russia's squabbling with Europe about whether they're going to continue to pump oil through Ukraine. We've got Iran sitting in the wings, wanting to get back into the world market, but can't because of the sanctions. If we resolve our issues with Iran, they can start pumping again. That could be even more oil. So the effect of these disruptions in the international petroleum market are, the potential for those is high. And I suspect that the long-run trend in increasing prices is going to be disrupted by some of those disruptions.
In 1975, the U.S. placed a ban on crude oil exports, but Dick says he believes that ban will be lifted, but doesn't think it'll have the same impact it would have had if it were done a year ago. The December Nebraska farmer says the common refrain about younger farmers finding it difficult to get into farming may be changing. According to this month's issue, USDA figures show the number of Nebraska's principal farm or ranch operators 35 years and younger grew by 42% from 2007 to 2012. That reverses a 30-year trend of declining numbers in that age group. The USDA figures also show the state's total number of farm or ranch operators also grew, going from 47,712 in 2007 to 49,969 in 2012. One key factor in both categories is the increase in popularity of farmers markets and the buy local phenomena. You can read more about these numbers in the December Nebraska Farmer. UNL Extension is releasing 69 crop budgets for Nebraska this year, As you'll hear in a minute during our discussion with Roger Wilson, the cost for producing corn and soybeans in 2015 looks to be higher than 2014. We should be clear the budgets are a broad example of production across Nebraska, and individual operations and returns will be unique. But hopefully the information can give some insight into thinking about costs heading into the next growing season.
Well, we get prices and stuff from Bob Klein. He has some contacts in the industry, and so we get some estimates as far as what he thinks the price is going to be. And these estimates, sometimes they are that right, and sometimes as time passes, they get a little bit wrong. I know this year we dropped the price of fuel down from $3.50 to $3.25, and I thought, boy, has that gone too low? And the way it turned out, that's way too high.
As a whole, what are input costs looking like this year? More expensive than last year?
Well, the way things work out on the budgets, it seems to be these costs have seemed to go up a little bit. Although as you look at the individual prices, or at least our estimates of what the individual prices are, it's really a mixed bag. Some things have gone up and a few things have gone down in price.
Let's look at a few crops here. Let's start in irrigated soybeans.
Well, the price of irrigated soybeans, according to the budgets that I've done, the price per bushel produced has gone up from $10.92 to $11.14 per bushel, 22 cents per bushel. And if you look at just a cash basis, not looking at the opportunity cost for the land and the machinery, the cost per bushel is gone up from $4.87 to $5.12, which is a 25-cent increase.
And in corn this year?
Well, corn, it's a lot like soybeans in the fact that we find that the prices have gone up. If you look at the total cost per bushel of corn, it looks like it's increased 17 cents from $3.98 to $4.15. The cash basis has gone up from $2.38 to $2.52, which is 14 cents. On the dry land side, it's kind of the same type of a pattern. We find that it's less expensive to produce dryland corn, according to my budgets, than irrigated corn. And the price has gone up about 26 cents on the per bushel cost for the total cost, and about 7 cents on the cash cost per bushel.
As we talk about costs, one tool you've developed and recently released has to do with irrigation and determining the cost. Tell me about that tool.
Well, on the irrigated crops, irrigation is a major expense, particularly as it relates to fuel. And we have come up with a tool. I've written a tool that's on the internet. It's a little bit different than the other tools that we have. We have a lot of tools that are Excel spreadsheets that you download. This one here is a web application. Basically, you don't download anything on your computer. You fill in some numbers, and it calculates the cost. And the numbers that you fill in should be numbers that you know, like total cost, and then the answers that you get out of there ends up being cost per inch, and it divides fixed and variable expenses. The reason I designed this was there was a request for some of the producers are actually using their pivot to irrigate neighboring acres. And so you take a look and say, what is a fair price or a fair cost that you should charge your neighbors? So one aspect of this calculator is you can add some acres that you're going to be adding, and you can click on a button, and it will tell you what my idea of a fair share would be. And it divides it up. You have a fixed cost, so there'd be a charge, just a flat charge for the year, and then there'd be another charge on a per acre inch applied.
On the Market Journal website, we'll link to the 2015 Nebraska crop budgets. We'll also link to the Irrigation Cost Calculator and other resources on irrigation management. We mentioned last week how beef prices are continuing to climb at U.S. stores. This week, UNL Extension livestock economist Kate Brooks joins us to look at international demand. From January through September, the U.S. exported more than 1.9 billion pounds of beef and veal. That's ahead of last year's pace. Japan has been the biggest buyer, taking more than 500 million pounds, with Mexico second, importing more than 335 million pounds. As live cattle are currently about 30% more expensive than a year ago, we started our interview by asking Kate why it was important to watch U.S. beef trade for possible disruptions.
You know, as we talk about high prices, our there's two markets basically for our product. You know, one is domestic product and the other is international product. So any type of trade disruptions, as much of our product that is going into those external markets could cause direct implications on our prices.
Tell me about the impact that BSE had in 2003 to beef trade.
You know, trade was continuing to rise. We continued to export more and more product. As we got to 2003, it was December 2003 where a lot of the market shut off when we had that BSE outbreak. We lost 83% of our export market, and that had a big impact on prices. So any type of disruption like that directly impacts producers.
Since then, what has the beef industry done to regrow that?
You know, we've continued to, start opening more and more markets. You know, the big ones, Japan. Japan's finally back to pre-BSE levels and beyond. They had originally opened up to 20 months of age. In February 2013, they opened up to 30 months of age, and so we saw a huge demand there for U.S. beef products, and so we saw that surge in our export market.
So Japan's a big one. What are the other big importers of U.S. beef?
Japan, Canada, South Korea, Mexico, and Hong Kong.
Those are the big ones for U.S.
Those are the big U.S. ones currently.
Things today that you think could cause a trade disruption from U.S. beef?
You know, again, any type of disease outbreak, a lot of this is political issues sometimes, and so those things have impact. We saw Russia, some of those issues with,
the growth hormones.
The growth hormones, and so any type of hormone issue where, maybe they're looking at some food safety issues, whether or not it's scientifically based or not, they can have those disruptions.
If there were to be a trade disruption, would it have a bigger impact than in 2003 since there's been so much growth back from that?
There is. We're at, historically high export markets. We've grown beyond what we were at in 2003, probably about tenfold beyond where we were at. And so, a big disruption, something huge like BSE again, or similar type disease could cause big impacts here to the U.S.
I guess more apparent short term, what are some things that people can look at to see about demand? So strength of the dollar, economies in other nations, things like that.
Yeah, as we look at, our demand, things besides political issues, besides government issues, the economy is a big one. If they're continuing to grow, then they have increased demand potentially. We know as countries become more developed, the demand for protein products continues to grow. But as some countries enter recessions, that's where we start to see issues just because people can't afford those products.
What are some ways that the U.S. beef industry has diversified itself or put safeguards in place that would catch a fall?
We're not exporting just to one country. We export to Japan, Canada, Mexico, and the list goes on. And so, that's one way we safeguard. We're not sending all of our product, so if one country falters, we do have other countries that we are exporting those products to. And we're exporting different types of products to these countries. We're not just exporting ground beef all over the country. We're exporting every part of that animal. And so different countries have different products we export.
You can read more on this topic in a recent Cornhusker Economics article. We'll link to that on the Market Journal website. And now with this week's weather forecast, here's UNL Extension State climatologist Al Dutcher.
Well, folks, here we are again for the weekly forecast. Of course, last week we taped early due to the university shutdown for Thanksgiving Day weekend, but at that time we mentioned that the big storm system moving into California had the potential to drop some significant moisture. Indeed, that's exactly what happened. We had some localized flooding and some very welcome moisture across the northern half of the state, up towards 8 inches reported, and with more systems coming, this is a very good start to their water year, considering we have 2 solid years of drought behind us in that region. But more importantly, we talked about that system taking some of that energy and moving it across the southern plains as we got into the midweek period. Well, it's about 24 to 36 hours too fast with that system, but we did see it come out as we got into Thursday afternoon and progressed through yesterday through eastern Kansas and Oklahoma, and some of that moisture did come up into extreme southeastern Nebraska. For the most part, we were pretty much high and dry. Now, as we go through this next 7-day period, it does look like we are going to be fairly nice in terms of temperatures. An occasional cold front comes through, but it's only going to drop us a few degrees. So we're going to be well above normal. This is a complete reversal of what we've seen for the first 3 weeks of November. So when it's all said and done, we're probably going to balance out the 2 months and be fairly close to normal. So let's take a look and see how this forecast is going to bear out. We have a weak ridge across the southern plains, and we have a piece of energy moving the northern stream across the northern plains. This system will not have much of an impact on Nebraska, more than just pulling in some cooler air. So right now in eastern Nebraska for today, we have a slight cool northwest flow on the top of this ridge. Our temperatures are going to be confined primarily into the upper 30s to the low 40s, a little bit warmer toward the southwest. But more importantly, as the system moves across, it's going to start to drag a cold front through the upper plains region, and that will bring a little bit of clouds and possibly a few sprinkles to northeast Nebraska. But overall, it looks like a dry forecast. Will stay in the northwest flow, particularly on Monday. That'll allow some much cooler conditions across the northeast part of the state. Will be confined into the low to mid 30s. But as you get into western Nebraska, we're going to get a westerly flow coming down sloping, and that will warm conditions up into the mid 40s to possibly low 50s. And as we get into Tuesday, another weak wave moves across the Dakotas that might give a little bit of a reinforcing shot of cool air to extreme northeastern Nebraska. But overall, the majority of the states start a nice warming trend with actually seeing some mid 50-degree readings possible across western Nebraska. More importantly, as we get into Wednesday, now the ridge starts to expand and bubble toward the northeast in response to another big trough coming in the western United States. And so we are looking at temperatures that will primarily going to be in the 50s to possibly low 60s across the southwest. But more importantly, we'll start to see some of those 50s creeping into eastern Nebraska. As we go into Thursday, this big ridge sits over most of the central United States. Southwest flow brings very warm conditions. We will be looking at 60s to possibly even a low 70 across southwest, and eastern Nebraska will primarily upper 50s to low 60s. And the same pattern holds true for Friday as we hit the southwest flow, bringing in those warm conditions. As we look at the temperature forecast, nothing to speak of in terms of precipitation, just a gradual warming trend as the week progresses. 8 to 14-day forecast indicates the warm conditions from next Thursday to the following Tuesday will continue nationwide. And in terms of precipitation, a very dry forecast for the northern plains, including Nebraska.
Thanks, Al. Today's interviews can be found on the Market Journal website and through the Market Journal mobile app. They include information on corn and soybean markets, oil prices, 2015 crop budgets, and U.S. beef trade. As always, you can keep up with Market Journal during the week by following us on Instagram, Facebook, and Twitter. Next week, Nick Miller from Stuart Peterson will analyze corn and soybean markets, and Brad Lubin will talk about farm bill decisions. Until then, thanks for watching. I'm Jeff Wilkerson. We'll see you next week.
Join Market Journal online at marketjournal.unl.edu. You can also follow us on Facebook and Twitter. Promotional support is provided by the Nebraska Farmer Magazine. Funding for Market Journal is provided by the Nebraska Soybean Board. The Soybean Checkoff, growing opportunity from the ground up. Market Journal is produced by the University of Nebraska-Lincoln's Institute of Agriculture and Natural Resources. Funding for Market Journal is provided by the Nebraska Soybean Board.
Animal agriculture is vital to Nebraska. Livestock production not only contributes to our food supply, but also helps our rural communities. Livestock provides revenue for schools, creates jobs, supports Main Street, and enhances the future for farm families. The Nebraska Soybean Board's Animal Agriculture Initiative works to encourage growth of responsible livestock enterprises to benefit agriculture and Nebraska.